Hi guys, it's Doc's Market Minute. Just a quickie here today. This is Netflix, and what I'm seeing on Netflix as we look at trend, obviously the trend is up on the monthly chart. The trend is so far up also on the weekly chart after a quick dip in August. And now we have trend working itself higher with a higher low, and today is breaking above into a higher high on the daily chart. Now looking at the energy perspective, here we have some energy on the monthly chart, but we don't really care that much about that since we don't intend to take an option trade for months and months and months. So as long as it has some energy, then what we're going to look at here is the weekly and the daily charts, and both of these are fairly well wound up right now. Range contraction like this leads to range expansion. This is just like winding the spring up and letting it go. So what can we do here to the upside? Well, first of all, what we can do is, let's see what our overhead resistance here is. The high watermark is just above 129. So we got about 13 points of room to go here. Let's see if we can fit a trade inside of that. Let's look at the Netflix option chain, and we're going to set this up for probability. And November is obviously too short. If we go to December, that gives ourselves about a month for this trade to move, and we have about a 14-point move, expected move to the upside. So that's good. We can actually fit our trade within there. So if we add the current price, which is 117 plus 114 or plus 14, that's about 131. It's pretty close. It's pretty close. So let's look and see what, well, it looks like we must have had a split here because we got some funny strikes that are set up here. So this is going to be kind of unusual. I much prefer to use the round number strike. So if we just wanted to set up something maybe targeted at 130, 135, we can then set up an expected move trade. What it's showing us is that we've got about a 68% probability of the price being somewhere within the range plus minus 14 points between now and December expiration. So what we're doing is we're using the trend and saying the trend is pointing to the upside. This looks like it's strong and is breaking out to the upside, and we think that we may have a retest of those highs. We can set up a debit spread such as a 130, 135, and in this case it's going to be not the cheapest trade that's out there. We're going to be paying, let's change this strike to the 135. So the risk on this is going to be limited to somewhere around 80 some dollars, $85 per contract for this. So I prefer narrower spreads where we can be more granular with our risk. So I think this is an odd situation because I think Netflix has just done a split. So this is pretty common when you have splits. You have weird strikes. But as we go out to, actually something that we can do maybe is go out to January and see what we have there. See if that has improved at all. Probably not. I think we're going to have the same situation out there in January. So anyway, you can see how you can set up an expected move trade here to December if you think that the highs are going to be retested again for Netflix between now and December. Setting up an expected move debit spread is a lot less expensive than buying a call option. If we were just to buy a call option here for the December cycle, the typical methodology behind that is to go ahead and buy the 70 delta call option so you avoid that volatility crush, and that's going to run you almost $1,100 per contract for that. So that's a wasting asset that doesn't have a whole lot of time left to go. Not very possible to trade that within small accounts, but you can see with the debit spreads you can trade those within small accounts and still work those into your maximum risk equation. All right, guys, that is it for today's report. Thanks for listening, and we'll see you tomorrow.